let's compare now some of the ideas. If there was no planning done for Georgia Peach and her son Bubba, what would be the result of that versus using some of the suggestions that we've come up with? So again, if she were to pass away, God forbid, today, net assets to the family would be $27 million. And that's a best case scenario because, again, remember, we have to sell a bunch of real estate in order to raise enough money to pay the estate tax of almost $10 million. In terms of the gross income to the family in year one coming from the LLC and the other instruments, $340,000, and that's basically coming from her tax return. Whereas with planning, the amount going to family would be $39 million. Could be more than that, but we're just being a little more conservative. So that's putting at $39 million, and $18 million though going to her family giving fund, going to various charities, and that can continue to go on in perpetuity or until it's all spent. But more importantly, from an income planning standpoint, even with paying for the life insurance, the net after-tax income in the first year is over $700,000. Or as you can see, it is over double what the income is with no planning. And again, remember, that's after paying for the life insurance. What about year 24 at age 100? Well, best case scenario, and more likely an overreach to say this, but would be almost $49 million to the family. But a $26 million estate tax makes it highly unlikely, frankly, that this family is going to inherit anything. So instead, if we use the planning that we've outlined, as you can see, $57 million to the family. Again, we're only using a 3% growth rate here. So far more likely that number is going to be bigger. Zero estate tax. Remember when I told you estate taxes are optional. You don't have to pay them and you won't go to jail. And in this case, we're providing $33 million to go to voluntary philanthropy, as opposed to the $26 million of involuntary philanthropy, also known as estate tax. So altogether, a 65% increase in the amount of net wealth going to the family, plus then, of course, the extra $33 million that's going to go to make a difference in the lives of the people for lasting positive good. Now, some people, just doing a brief aside, some people have heard of something called a charitable remainder trust. Does that ring a bell at all? Well, the Charitable Remainder Trust is another one of the tools that was created in that 1969 Tax Reform Act. It's a very useful tool. I've used it in many, many different times. It created a number of these, but I don't anymore. I don't like them as well as I compare it to the PPT. It has basically everything you might love or appreciate about having a tax deduction, having an income stream, protecting assets from creditors, also being able to sell assets and not pay any tax at all. Or again, making capital gains taxes optional. But because of the PPT, it has much more flexibility. That's just the instrument. Not only does it create more tax deduction, but there's no minimum payout rate. There's no required amount that has to be there at the end of the day. Although typically with these, there's far more left in the bucket than when we start. So it is, and on top of that, again, banks will loan money to these. If you want to buy real estate on a leverage basis, can do that with a PPT. You cannot at all with a CRT. It creates something called unrelated business taxable income. And $1 of UBIT, as that's referred to, will kill the charitable trust on the left side. Right side, nope, all good. And there, I'm going to kind of blow through this just because one of the other things, with the exception of one thing, unless you have someone who's in their 80s, and as I had in one case, we were able to do 2 generations with a charitable remainder trust or a CRT because he was old enough and his daughters were in their 56 and 54 that we were able to make that trust work based on what the numbers are that have to be there at the end. Whereas but that's unusual. Normally with a charitable remainder trust, you're only going to get 1 generation worth of income. However, with the PPT, as I mentioned, another case, not one of my own, but another case where the generation 1, he was 92, and generation 4, that's going to continue to receive income as well, had just turned 6 months. So you could take these things and generate income for a long time. But if you also choose to, in most cases, just have it go a couple generations, that's probably a better way to do it. And if you want to have more income go to gens 3, 4, 5, 6, we can do that with insurance inside of a special asset replacement trust. Now, I don't want you to look at this because it's going to put the eyes in the back of your head. But just basically, this is to say, we got the numbers to show you how we came up with what we got. All right. So just kind of summarizing things, end of year 24, using the planning that we're suggesting, 0 estate tax, even then. Even with a $75 million estate at that point, 57 will go to the family, 34 million to philanthropy, either their family giving fund or other charities or some of both. So that's the 34 million of income to the family and 33 million to philanthropy. That's how you make a difference in a lasting positive way, doing well for the family at the same time you're doing well for the country and for its people, for our people here.